Welcome we're in Ada Dumalang Molo Solbona Hukandit, and a warm welcome to the Indufo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today,
Hmm.
we're going deep into the world of international financial reporting. Don't worry, we'll make it fun. And painless. Promise. Specifically, we're unpacking IFRS 8, which deals with how companies report on their different business segments. Ever wondered how big companies like, say, ShopRite break down their financials? IFRS 8 is the rule book.
It's fascinating how this standard really shines a light on the inner workings of a company. Before IFRS 8 came along back in 2006, things were a bit like trying to navigate Joburg traffic with a map from the 80s.
Talk about a headache. So IFRS 8 is like our trusty GPS for the corporate world then.
Exactly, IFRS 8, or operating segments to use its full title, replaced the old IAS 14 to give investors a much clearer picture of a company's business activities, especially how they're performing in different economic environments. Think of it like this. You wouldn't judge a bride just by the borders.
Right.
You'd want to see the whole spread, the pap, the chakalaka, the salads, the whole shebang.
Now you're making me hungry.
Yeah.
But I get your point. So IFRS 8 helps us see the whole BRI spread of a company's operations.
Spot on. And just like not every BRI has the same setup, not every company has to follow IFRS 8. It mainly applies to companies listed on the stock exchange or those planning to list, whether it's the JSE here at home or some fancy international market. Those consolidated financial statements for big groups of companies, where the main parent company fits the listing criteria, also need to comply.
Okay, so if a company wants to attract those big investors, they need to show their cards clearly.
Exactly. Transparency is key. But if you're running a small business, like a spaza shop or a Shisanyama spot, you're not obligated to use IFRS 8.
Got it. So for those companies that do need to comply, how do they even begin to figure out what an operating segment is? It sounds a bit technical.
Well, imagine your business is like a soccer team. Each operating segment is like a key player on the field. Your midfield maestro, your rock-solid defender, your goal-scoring striker.
I like where this is going. So how do we know if a part of the business is a star player? I mean, a reportable segment.
First, it needs to be pulling its weight by bringing in revenue and, of course, having expenses. This even includes transactions within the company itself. Think of it like a midfielder passing the ball to the striker. It's all part of the same team, but each player has their role.
So even those internal dealings matter. Makes sense. What else makes a segment a star player?
Well, they need a coach keeping an eye on their performance.
Right.
In the corporate world, this is the chief operating decision maker, or key ODM. They're the ones making the big calls about resource allocation and performance assessments.
So the key ODM is like the coach, making sure each player is performing at their best. But wouldn't that usually be the CEO?
Not always. It depends on the company's structure. Sometimes it's a board of directors, a high-level management team, or even a specific manager responsible for that segment.
Okay, so we've got our revenue-generating player with a coach keeping them in check. What's the third criteria?
They need their own stats sheet. Each operating segment needs its own separate financial information. Revenues, expenses, assets, liabilities, all tracked separately from the rest of the team. Think of it like keeping track of each player's goals, assists, and, well, maybe even yellow cards.
Love the analogy. So it's not just about dividing a company into random departments. It's about identifying those key parts of the business that are really driving its performance.
Exactly. And remember, not every part of the team is a star player. A company's headquarters, for instance, might not generate revenue directly. Think of it like the team's back office staff, essential to the operation, but not on the field scoring goals.
Makes sense. So how does a company actually decide which of these star players are important enough to get their own detailed report in the financials?
That's where the concept of reportable segments comes in. IFRS 8 lays down some ground rules to make sure companies are transparent without overwhelming investors with too much information, basically. If a segment makes a significant contribution to the company's revenue, profit, or assets, it earns its spot in the limelight. It's like saying, hey, this player is scoring a hat trick every game. Investors need to know about them.
Okay, so we're looking for those segments that are really moving the needle. What counts as a significant contribution?
The general rule of thumb is if a segment contributes 10% or more to the company's total revenue, profit, or assets, it needs to be reported separately. This helps you quickly identify the core parts of the business.
That makes sense. But what if management thinks a segment is important, even if it doesn't quite hit that 10% mark? Do they have any wiggle room?
They do. IFRS 8 understands that sometimes you have a player with massive potential, even if they haven't scored a goal yet. Management can choose to report on a segment separately if they believe it's crucial for investors to understand, even if it doesn't meet those 10% thresholds.
So it's not just about crunching numbers, it's also about management's judgment and insights into the business.
Absolutely. And on the flip side, what if a company has a bunch of smaller segments that don't individually meet the reporting thresholds?
Yeah. What happens to those players who haven't quite made it to the first team yet?
Well, IFRS 8 allows companies to combine similar smaller segments into a larger reportable segment. As long as they have similar economic characteristics, think of it like grouping together a few promising young players from the development squad.
So, similar economic characteristics, does that mean they all wear the same colored boots or something?
Uh-huh. Not quite. It means they operate in similar ways and are likely to have similar financial performance over time. For example, imagine a company that sells both red and blue shoes through the same channels to the same types of customers, and those shoes are made in basically the same way. Those could be combined into a single segment for reporting purposes.
Okay, so it's all about giving a clear picture without getting lost in the weeds. But what's to stop companies from being sneaky and hiding a big chunk of their business in the shadows?
That's where the 75% rule comes in, basically. All those reportable segments combined need to account for at least 75% of the company's total revenue. If they don't, the company has to keep identifying more reportable segments until they hit that 75% mark. It's like making sure the starting lineup actually represents the strength of the whole team.
Ah, so it's a safety net to make sure companies aren't hiding their star players on the bench. So
Hmm.
what happens to all the smaller segments that don't end up being reported individually? Do they just disappear?
Not quite. They get grouped together into a category called all other segments. IFRS even requires companies to explain where the revenue in this category comes from, so investors have some context. It's like acknowledging the contributions of the reserve players and the coaching staff, even though they're not in the starting lineup.
So it's all about giving a complete picture, even if some parts are a bit more behind the scenes. But what happens when a player gets injured or, in business terms, a segment starts underperforming? Does it get dropped from the reportable segments?
Not necessarily. If a segment was reportable in the past and management still considers it important, they should keep reporting on it separately, even if it doesn't meet the thresholds anymore. Think of it like a star player recovering from an injury. They might not be scoring goals yet, but the team is still invested in their recovery.
So, once a segment earns its star status, it's not easily forgotten. It's about consistency and giving investors a clear picture of how things are evolving over time.
Exactly. And just like a new signing can shake things up, if a new segment emerges as reportable, the company needs to go back and restate its prior year's data to include this new segment, as if it had always been there.
Whoa, that sounds like a lot of paperwork.
It can be. But IFRS 8 recognizes that sometimes digging up old data might be too costly or impractical in those cases. It's okay to acknowledge that the restatement wasn't possible.
Okay, so there's some flexibility built in. Now, what happens if a company have a massive team, like a whole league of players? Do they really have to report on every single one?
Not necessarily. While there's no hard limit, IFRS 8 suggests that if the number of reportable segments gets too high, say above 10, the company should think about whether all that detail is actually helpful. Imagine trying to follow a game with 20 players on each side.
Yo, I need a spreadsheet and calculator just to keep up. So it's about finding that sweet spot between transparency and information overload.
Exactly. IFRS 8 wants to make sure investors understand the game, not drown them in stats.
Okay, that makes a lot of sense. Now, we've talked about identifying these star players, but what kind of information does a company actually have to disclose about them? What stats are we looking at here?
Well, think of it like this. You wouldn't just list the players' names on the team sheet.
Right.
You'd want their jersey numbers, their positions, maybe even a little bio about their strengths and weaknesses.
Okay, so IFRS 8 is like the detailed program you get at a soccer match, giving you the inside scoop on each player.
That's a great way to put it, first off. Companies need to give some general information about each reportable segment, like how they identified it, how it fits into the overall structure, and what kind of products or services it offers. Think of it like introducing the players, telling us what position they play and what their special skills are.
All right, that's our intro. Now, give me the juicy details. What kind of financial stats are we looking at for each segment?
Well, the main event is the segment's profit or loss. How many goals did they score, so to speak? And if they're tracking assets and liabilities at the segment level, Those need to be reported too. This gives us a sense of the resources each segment is using and the financial risks they might be carrying.
So we get to see each player's individual scorecard and how they're contributing to the team's overall success.
Exactly. But it goes beyond just the final score. IFRS 8 wants to know about the specific moves that led to those goals. They require companies to disclose specific revenue and expense items, like sales to external customers, any sales between segments within the company, interest revenue and expense, depreciation, big one-off income or expenses, and even their share of profits or losses from investments in other companies.
Wow, that is a lot of detail. It's like analyzing every pass, every tackle, every shot on goal.
You got it. And just like a ref can call for a video replay to make sure a goal was legit, IFRS 8 requires companies to reconcile all those segment-level figures back to the overall company financials.
Ah, so it's like a double-checking mechanism to make sure all the pieces of the puzzle fit together.
Precisely. They need to show how the revenue, profit or loss, assets, and liabilities of all those segments add up to the company's total figures. And if there are any discrepancies, they need to explain them clearly. This helps investors make sure the company isn't trying to bend the rules or hide any fouls.
Okay, so IFRS 8 keeps everything above board. Now, what about those companies that are like a one-man show? They might be a star player, but they're the whole team rolled into one?
Yeah.
Do they still need to go through all this IFRS 8 rigmarole?
Even solo acts need to follow the rules of the game. IFRS 8 requires companies, even those with just one reportable segment, to disclose some additional entity-wide information.
So even if you're the only player on the field,
Yeah.
you still need to show the ref your stats.
You got it. Even for these simpler companies, IFRS 8 wants to know about their products and services, the regions they operate in, and their reliance on any major customer.
Okay, let's break those down one by one. What kind of information do they need to reveal about their products and services?
They need to break down their revenue by product or service line, or at least by groups of similar products and services. This helps investors see where the money is coming from, even if there's only one main segment.
So even if you're a one-man show, you still need to tell us what tricks you're performing to earn those cheers.
Right, exactly. And then there's the geographical information. Even solo artists might tour in different cities or countries. Companies need to report their revenue and non-current assets by location, distinguishing between their home country and any foreign countries where they operate.
So if a South African company is selling its products in other African countries, they need to break down how much revenue is coming from each place. It's like knowing how many tickets you sold in Josie versus Durban.
That's a great analogy. And if a company makes a lot of its money from a particular foreign country, they need to disclose that separately. This gives investors insight into the company's global reach and any potential risks or opportunities in those different markets.
Okay, that makes sense. Now, what about those major customer disclosures? Is that like knowing who your biggest fans are?
Exactly. IFRS 8 requires companies to disclose if they rely heavily on any single customer for their revenue. If one customer accounts for 10% or more of the company's total revenue, they need to disclose that, along with the total amount of revenue from that customer.
So if a company is basically singing to just one superfan, and that fan decides to stop coming to shows, the company is in trouble.
Right.
Investors need to know about that kind of risk.
You got it. That kind of concentration can be a major vulnerability. So transparency is key, of course. The company doesn't have to name names, but they need to disclose the level of dependence.
Makes sense. Now, how about when a company works with the government? Like they're putting on a show for the Department of Arts and Culture and a bunch of provincial arts councils. Does that count as one big fan or many smaller ones?
That's a tricky one. When it comes to government entities, IFRS 8 acknowledges that it takes some judgment to figure out if they should be considered one single customer or multiple customers.
So they need to use their brains and look at the bigger picture. It's not just about blindly applying the rules.
Exactly. And I think that's a key theme throughout IFRS 8. It's not just about ticking boxes. It's about using judgment, applying principles, and giving investors the information they need to make smart decisions.
Well said. I'm already feeling much more clued up about this whole IFRS 8 thing.
Me too. It's amazing how much thought goes into making sure financial reporting is clear and honest.
Absolutely. Now, IFRS 8 has been around for a while. Did companies have time to adjust to these new rules, or was it like a sudden change?
They had some time to get their act together. IFRS 8 officially took effect for companies' annual reports starting in 2009, replacing the old IAS 14 standard. They encouraged companies to adopt it early, But there were also some transition rules to help them make the switch smoothly. It wasn't like a ref suddenly changing the rules in the middle of a game.
Okay, that's good to hear. So, now that we've covered the basics of IFRS 8, how can we use this knowledge to actually understand a company's strategy and figure out their potential for the future?
That's a great question. And it's exactly what we'll be tackling in the next part of our deep dive. Stay tuned, folks, because things are about to get even more interesting. Welcome back to the Indubo Knowledge Cast. We've unpacked the basics of IFRS 8, and now it's time to put on our analyst hats and see how we can use this knowledge to gain valuable insights into a company's strategy and potential for the future.
Sharp. It's like we've learned the rules of the game, and now we're ready to analyze the players and predict who's going to win the championship.
Right. You got it. IFRS 8 isn't just about dry reporting. It's about understanding how a company thinks about its own business. By carefully examining those segment disclosures, we can get a glimpse into management's strategic priorities, see where they're focusing their resources, and get a sense of how they see the company evolving over time.
So it's like having access to the team's playbook.
Exactly. Let's say you're looking at a company's financials and notice that one particular segment has been growing like a weed, both in terms of revenue and profitability. It's outperforming all the other segments. What might that tell you?
Well, it could be a sign that management sees that segment as a real star player, the key to their future success. Maybe they're investing heavily in that area, launching new products, or expanding into new markets.
You're reading the game like a pro. And by comparing the performance of different segments over time, you can start to see which parts of the business are gaining momentum and which might be struggling to keep up. This is especially useful in industries that are changing rapidly.
Okay, so strong segment performance could signal growth opportunities. But what if a segment is consistently underperforming? What kind of red flags should we be looking out for?
That's a great question. If a segment is lagging behind, it could be a sign of trouble brewing. Maybe they're operating in a shrinking market, facing fierce competition, or dealing with some internal inefficiencies. It's like a player who keeps getting benched because they're not performing up to par.
So it's important to try and figure out why a segment is underperforming. What clues should we be looking for?
Don't forget that management commentary that comes with the financial statements. They might talk about challenges specific to that segment, any plans for restructuring or turnaround efforts, or even hint that they might consider selling off that part of the business.
So the management commentary is like the coach's post-game interview, giving us insights into their strategy and their thoughts on the players.
Exactly. It provides valuable context and helps connect the dots between the numbers and the company's overall direction. Remember, financial statements are a way of telling a story, and the management commentary is where the narrative comes to life.
Okay, I'm seeing how all these pieces fit together now. How can IFRS 8 help us understand how a company is performing in different parts of the world? That seems pretty crucial these days, with so many companies operating globally.
You're right. Geographical performance is key in today's interconnected world. IFRS 8's geographical disclosures can be incredibly valuable for understanding a company's global footprint and spotting those potential risks or opportunities tied to specific regions.
So it's not enough to just know the total revenue. We need to know where it's coming from. Is a band more popular in Joburg or Cape Town?
Exactly. Imagine you're analyzing a South African company that's expanding into other African markets. By looking at the geographical disclosures, you can track the growth of those new markets, see how much they're contributing to overall profitability, and even spot potential challenges they might be facing.
Challenges like currency fluctuations,
Wow.
political instability, or supply chain disruptions. Eesh, those can really throw a spanner in the works.
Yeah, no doubt. Those are all factors that can have a massive impact on a company's performance in different regions. And IFRS 8 gives us a framework for systematically analyzing those geographical dimensions.
Okay, so geographical disclosures help us assess a company's global game plan. Now, let's talk about those major customer disclosures. How can that information give us a strategic edge?
Now we're getting to the heart of the matter. Understanding a company's customer concentration, who their biggest fans are, can reveal a lot about their bargaining power, their vulnerability to losing customers, and even their potential for growth.
So if a company relies heavily on just one or two big customers, that's a bit like putting all your eggs in one basket.
Right.
It's risky.
Absolutely. If a major customer suddenly jumps ship or faces financial difficulties, it can have a huge impact on the company's bottom line. It's like a band losing their main sponsor. It can really hurt.
Makes you think twice about putting all your faith in one big fan.
But what if those major customer disclosures show that a company is gaining traction with a new, high-growth customer? Could that be a sign of good things to come?
Absolutely. Landing a major new customer can be a sign of a company's competitiveness, the appeal of its products or services, and its potential for future growth. It's like a band getting signed to a major label, a real boost for their career. I like how you're weaving these analogies into our conversation. It's making IFRS 8 much more relatable. So
Yeah.
it sounds like IFRS 8 isn't just about looking at past performance. It can actually help us predict a company's future moves.
You got it. By carefully analyzing those segment disclosures, geographical information, and major customer details, we can start to anticipate potential risks and opportunities, identify emerging trends, and gain a deeper understanding of a company's competitive landscape. It's like being able to see a few moves ahead in a chess game.
This is all making a lot of sense. But let's be honest, sometimes these financial statements can feel a bit like trying to decipher hieroglyphics. Any tips for us ordinary folk who aren't accounting whizzes?
Don't worry, you don't need to be a chartered accountant to make sense of this. Remember that management commentary we talked about? That's your secret weapon. It often provides valuable insights and explanations that can help you interpret the numbers.
So don't be afraid to read between the lines and look beyond the raw data.
Exactly. And don't underestimate the power of comparing a company's disclosures over time. Look for trends, patterns, and any major changes that might signal a shift in strategy or performance. It's like watching a movie and paying attention to the character development, the plot twists, and the foreshadowing.
I love that analogy. We're like financial detectives, piecing together the clues to uncover the secrets of a company's success.
Exactly. With IFRS 8 as our guide, we can decode those financial statements and unlock valuable insights that can inform our investment decisions or simply deepen our understanding of the business world.
Well said. Now, I'm keen to hear what other insights you have in store for us. What other aspects of IFRS 8 should we be paying attention to?
That's a great question. In the next section, we'll delve into some of the more subtle aspects of IFRS 8, exploring how it can shed light on a company's financial health, risk management practices, and even their approach to sustainability.
Ooh, I'm intrigued. It sounds like we're about to uncover even more layers of the onion. Stay tuned, listeners, because the plot thickens. Welcome back to the Indubo Knowledge Cast. We've journeyed through the heart of IFRS 8, explored its use in understanding a company's strategic moves, and honed our financial detector skills. Now, we're turning on our X-ray vision to see how this standard can reveal even more about a company's financial health, how they handle risk, and even their commitment to sustainability.
Yeah, it's like we're on a game drive, spotting those subtle tracks and signs that tell us about the health of the whole ecosystem. And IFRS 8 is our trusty field guide, helping us assess not just what a company has done, but how prepared they are for the future.
Okay, I'm grabbing my binoculars.
Right.
Where do we start this safari of insights?
Let's begin with financial health. One of the key things IFRS 8 helps us assess is how diversified a company is. Think of it like a diverse herd of animals. If there's a drought that affects one species, the others can help keep the ecosystem balanced.
So diversification is like having a balanced portfolio, spreading your risk across different assets.
Mhm.
But how does IFRS 8 help us judge a company's diversification?
Well, by looking at the relative size and performance of those different segments, we can get a sense of how well-rounded their revenue streams are. If one segment is the big elephant in the room, it could make the company vulnerable.
And so imagine a company that relies heavily on selling, let's say, those old school Nokia 3310s. Sure, they're tough as nails, but the world has moved on to smartphones. That wouldn't exactly be a sign of a healthy, adaptable business, would it?
Exactly, and IFRS 8 allows investors to see those potential weaknesses early on. By understanding the breakdown of a company's revenue sources, we can make a more informed judgment about their chances of survival. I mean, their long-term prospects.
Okay, that makes perfect sense. Now, how about risk management? I know companies face all sorts of challenges, like those economic storms that can hit unexpectedly or those supply chain snags that leave everyone hanging. How does IFRS 8 help us understand how companies are dealing with these potential potholes?
You know, IFRS 8 doesn't come right out and tell us about a company's risk management strategies, but it does drop some hints. Remember those geographical disclosures we talked about?
Yeah.
If a company has a big chunk of their operations in a politically unstable region, that could be a sign of high geopolitical risk.
So those disclosures are like those warning signs you see on Safari. Beware of the lion, prompting us to be a little more cautious.
Exactly. It's a sign to dig a bit deeper and see how the company is mitigating those risks. And by looking at the performance of different segments over time, we can get a sense of how resilient they are to those external shocks. Did they bounce back after the COVID-19 pandemic like a springbok after a cheetah chase? Or did they struggle to adapt?
Those are great points. It's like IFRS 8 gives us a sneak peek into a company's ability to handle those unexpected twists and turns on the road.
Precisely. It's not a crystal ball,
Yeah.
but it provides valuable data points that can inform our assessment of how well a company is managing those inevitable bumps in the road.
Okay. I'm seeing how IFRS 8 helps us check a company's financial fitness and their risk management skills.
Mm.
Now, let's talk about sustainability. It's a topic that's gaining more and more traction these days. And for good reason. It's not just about profits, it's about doing business the right way.
Absolutely. Investors are increasingly wanting to know how companies are handling those environmental,
Yeah.
social, and governance issues, those ESG factors, as
Yeah.
they're called.
Right. It's like making sure our safari vehicle doesn't damage the environment or disturb the animals. We want to enjoy the experience while leaving a minimal footprint.
Exactly. And while IFRS 8 doesn't specifically require companies to report on sustainability, it can give us some clues about how their operations might be impacting those ESG factors.
Really? How so?
Well, think back to those segment disclosures. If a company has a segment that's heavily reliant on, let's say, those plastic straws everyone's trying to get rid of, that could signal some environmental risks.
Yeah.
Or if a company has a big factory in a country with questionable labor practices, that could raise some red flags about social responsibility.
So, IFRS 8 helps us connect the dots between a company's actions and their impact on the bigger picture.
Exactly. It's not a replacement for dedicated sustainability reports, but it can be a starting point for further research and engagement with the company.
This is amazing. It's like IFRS 8 is giving us a panoramic view of the whole landscape, helping us understand how businesses operate and how their actions ripple out into the world. But I have to admit, it can feel like drinking from a fire hose sometimes. Any advice for our listeners on how to digest all this information without getting overwhelmed?
Don't worry, you don't need to be a game ranger with years of experience to navigate this terrain. Remember those key areas we've discussed? Segment performance, geographical disclosures, and major customer relationships. Start there.
So, start with those big landmarks and gradually zoom in for a closer look at the details.
Spot on. And, as always, don't be shy about asking questions. If something seems unclear or you need more information, reach out to the company or chat with a financial advisor. There are plenty of experts out there who can help you understand the finer points.
Okay, that's helpful advice. I guess the big takeaway here is that IFRS 8 isn't just a dusty old rulebook. It's a powerful tool that can empower us to make more informed decisions. Whether we're seasoned investors, curious analysts, or just everyday citizens who want to understand how businesses tick.
Couldn't have said it better myself. It's about understanding how businesses work, how they create value, and how they impact the world around us. And IFRS 8 gives us a common language to engage in those conversations.
Well said. I think our safari through IFRS 8 has been incredibly enlightening. Any parting words of wisdom for our listeners before we wrap up?
The most important thing to remember is that IFRS 8 is all about transparency. It's about shedding light on how companies operate, how they manage their risks, and how they're creating value for their stakeholders. It's like those spotlights on a night drive, illuminating the hidden wonders of the bush.
And that transparency is crucial for building trust, making smart decisions, and holding companies accountable. It's about making sure they're playing the game fairly and responsibly.
You got it. So, the next time you encounter a company's financial statements, don't be intimidated. Remember that IFRS 8 is your trusty compass, guiding you through the terrain and helping you discover those hidden gems of insight.
Well said. Thanks for joining me on this fantastic journey into the world of IFRS 8. It's been a real eye-opener.
The pleasure was all mine.
And to our listeners, a big thank you for tuning in to the Indubo Knowledge Cast. We hope you've enjoyed this deep dive and learned something new along the way. Until next time, keep those minds curious and keep exploring.